Okay, so for any founder out there trying to raise money, there is one document that venture capitalists will scrutinize more than almost anything else. Seriously. It's not just about how cool your product is, it's about your blueprint for actually winning. This is the story of that blueprint.
But first, let's kick things off with a pretty sobering number, 42%. That is the percentage of startups that ultimately fail. It's a huge, kind of scary number, and it begs a really important question.
You know, we all tend to assume that failure must come from a clunky product or some kind of buggy technology. But the data, it tells a completely different story. So if a truly game-changing product isn't enough to guarantee you'll make it, what's the real culprit here?
And here it is, the single biggest reason startups die. They build something beautiful, something elegant, an innovative solution to a problem nobody actually has. They create something nobody is willing to pay for. It is a fatal, and you'd be surprised how common, mistake.
So how do you avoid becoming just another one of those statistics? Well, the answer is having a rock-solid go-to-market strategy, or GTM for short. This is the playbook. It's the thing that directly tackles that #1 reason for failure, by proving from day one that there's a real, hungry market for what you've built.
Now, it is absolutely crucial that we clear up a huge misconception right now. A GTM strategy is not just a marketing plan. A marketing plan is like one chapter. It's focused on brand, ads, promotions. The GTM? That's the entire book. It's the whole business plan that pulls everything together. Sales, pricing, distribution, you name it.
To put it a little more formally, a GTM is your step-by-step battle plan for launching your product, finding that perfect customer, and then building a machine for scalable growth. Just think of it as the bridge that connects your brilliant product idea to a real, thriving business.
So how do you actually build one? A powerful GTM isn't just a document you write and then file away. Nope, it's a living, breathing engine for your company's growth. So let's take a look at the core parts you need to assemble.
We can really break this whole process down into 3 main pillars. It's pretty straightforward. First, you define your foundation. Second, you craft the engine itself. And third, you figure out exactly how you're going to measure success. Let's start with that first pillar.
Everything, and I mean everything, starts right here. Before you do anything else, you have to become obsessed with defining your ideal customer profile, your ICP. Who are they really? What are their deepest pain points? And from there, you build your unique value proposition, or UVP. This isn't just about what makes you different, it's about what makes your solution a must-have, not just a nice-to-have.
Okay, once that foundation is solid, you build the engine. This means choosing your sales channels. Are you going to be product-led, where the product basically sells itself, like Slack? Or maybe you'll use partners, which is more like Intel's model. You also have to nail down your pricing based on the value you provide, and this is a big one. Make sure your own teams are totally aligned and have what they need to win. That's sales enablement.
All right, so you've built your plan. Now let's switch chairs for a second and look at this from an investor's point of view. How does a VC actually judge if your GTM strategy is any good? I'll tell you this, they don't just take your word for it. They look at the cold, hard data.
And the language they speak is the language of unit economics. This is basically the math that proves whether your business model is healthy, profitable, and most importantly, scalable. It tells them if for every single dollar you put into the machine, you're getting more than $1 out. Simple as that.
Which brings us to the single most important number on any VC's checklist, 3-to-1. This is the magic ratio. It's the benchmark for your LTV to CAC ratio, which means the lifetime value of a customer needs to be at least 3 times the cost it took you to get them. This little ratio is the ultimate proof that your whole GTM strategy is actually working.
And that golden ratio is just part of a bigger dashboard. VCs are also going to be digging into your churn rate to see if customers are sticking around, your burn multiple to see how efficiently you're using their cash to grow, and your payback period, which really needs to be under 12 months. This table, it's basically the report card for your entire business model. But here's the thing. A GTM strategy isn't a static document you just create, check off a list, and then file away. The plan is just the beginning. The real test is turning that plan into reality, day after day after day. It's all about execution.
And this leads us to a much deeper question. When a VC is looking at your beautifully crafted GTM plan, your impressive metrics, what are they truly betting on? It's something much bigger than just the numbers on a slide.
They're investing in you.
They're investing in your team's ability to actually execute that plan, to learn from the market when things inevitably go wrong, because they will, and to adapt under incredible pressure. Your GTM plan is a test of your maturity and your resilience as a founder.
Ultimately, your go-to-market plan is so much more than a roadmap for growth. It's a proxy for your team's character. It proves that you can not only come up with a brilliant strategy, but that you have the grit to live it, the humility to learn from it, and the agility to adapt it when you have to. And that is what turns a great idea into a truly unstoppable business.